The dollar is on a tear, soaring higher after it was seemingly left for dead not all that long ago. But that just begs the question, why is the dollar surging? Is it Trump? Is it the Fed? Inflation? Janet Yellen? Burger King? You'll hear any number of explanations that run the gamut. The big problem with them, is that they all start from a national perspective. That it's the US dollar against someone else. Therefore, what's happening in America versus the situation in some other part of the world. But the dollar isn't the real currency in question. It's the Eurodollar's world, which means, among other things, we're looking at a truly international currency. Just like government bonds trade in largely synchronized fashion because of global factors, the dollar's behavior is explained by a more global perspective. When the demand for and supply of Eurodollar currency is determined by factors coming in from all over the world, sure, there's some room for idiosyncrasies, even some interest rate differences, as we'll see. But the big one is always some degree of risk on and risk off. It's not quite flight to safety, but that's at least thinking in the right direction. You'll see what I mean today when we take a closer look at two of the biggest exchange pieces, the euro and the yen. With those, at least we can eliminate central bank policy differentials, the most frustrating part of this whole topic. Like everything, we're supposed to believe if something happens, it's because some central bank did something somewhere. But as Alan Greenspan said in 1991, that's just the legacy of the modern central bank only having the one tool and then spending the last 4 decades successfully fooling much of the world into believing it must be the most influential tool ever invented. But over here in the real world, DXY just eclipsed 107, which is the highest it's been in almost exactly 2 years. And again, the question is, why? And the answers that you'll get from the mainstream are all over the place. Let's start with a couple examples. This one is from last month in October, when the dollar rally, at least the latest leg of it, or the latest part of it, was really just getting started. This is from Reuters on October 15th. The US dollar edged higher against most major currencies, resuming the latest uptrend that it took to more than a 2-month high, fueled by expectations the Federal Reserve will proceed with modest interest rate cuts over the next year and a half. So the dollar was too high before then because the Fed wouldn't cut, the idea of higher for longer. And everybody complained about the fact that the dollar was going higher and other currencies were falling because the Fed wouldn't cut. Now the dollar's going higher again here more recently, and it's supposedly because the Fed is cutting, but it's not cutting as fast as most expectations. This is what I mean when I say everybody is taught to believe that if something happens, it must be because something the Fed did or is going to do or might not do. Everything is brought back to the modern central bank, which is what central bankers are all about. But then there's this explanation from a couple days ago. This was printed in Bloomberg from JP Morgan strategist, and it said the election outcome amplifies the US dollar exceptionalism. No other currency has what the dollar has. Superior growth in equities, of course they're going to say that because they're strategists. Higher yield, and that's not necessarily the case, but also defensive attributes. And that's kind of backwards too, because we see throughout history, especially in the 21st century, the dollar goes lower when the economy is doing better. That was certainly the case in all of the reflationary periods. We get into a reflationary period where the US seems to be picking up, and the rest of the world does too, globally synchronized. The dollar's going lower, not higher. We see the dollar going higher, it leads to, if not in the middle of, a downturn, recession, crisis, dollar shortages. So the idea that a higher dollar is somehow a positive reflection on the United States, again, is first of all thinking in national terms rather than international terms, and it is backwards. Because remember, the Eurodollar is the vehicle currency for the entire world. Now, the one thing that the strategist wrote that does apply here, defensive attributes. Now, it's not quite flight to safety as most people get, but that's the idea. You see that type, the dollar rising when things are not going well. Risk off. Defensiveness. And that's where we've been for the last several years, going back to really 2021. The dollar has been in a narrow range since 2022. And what we're seeing more recently is maybe that it's breaking out to the upside. Now, they want to attribute that to Trump, and they want to attribute that to, like the strategist said, better growth expectations or interest rate differentials. The Fed isn't cutting as fast as it might have seemed a little while ago. But what we're really talking about is defensive attributes. Not really defensive attributes. It's supply and demand for Eurodollar currency. And there includes something like a risk premium. And that's what explains the dollar behavior just in the 2020s. You saw a huge rise in the dollar in 2022 as the world seemed like it was falling apart. Remember in 2021, everything seemed to be going in the right direction. Red hot economy, recovery, robustness. Governments had solved the pandemic and had created a permanent plateau of prosperity. That's what many people believe. Even Xi Jinping in China seem to believe it. So essentially 2022 was a massive slap in the face. There was all of these problems that were breaking out everywhere, not to mention, to start with, they lost purchasing power. Consumers and businesses were being left behind. Only few large businesses were really the beneficiaries from the supply shock era. So the dollar kept screaming higher as the risks seemed to get worse and worse and worse. But then late in 2022, heading into 2023, some of those worst fears were alleviated, especially the energy crisis and the worst aspects or the worst potential for that and the spillovers from it. And so the dollar backed off a bit. There was also reopening in China that was potentially a global positive. And throughout 2023 and into 2024, what did the dollar exchange value do? Well, according to DXY and other measures, it kind of just went sideways. It only backed off a little bit from its peak in 2022, peak risk premium, and then it went sideways, waiting for the world to shake out. Basically waiting to see if the situation could steady from there. As it seemed that the US was kind of hanging in there, reopening was happening, maybe Europe would come out of its funk after only a short recession. A lot of potential positive scenarios, which would have meant that the supply shock downside was, in fact, not all that much of a big deal. But on the flip side of all that, Europe wasn't able to shake out of its recession. China's reopening didn't solve the Chinese issue. And the US, rather than dodging a recession, has been facing stronger and stronger recession questions. So the risk premium that remained after 2022 was essentially not being able to put all of those risks behind. So the dollar traded in relatively narrow range over the last couple of years, waiting for one side or the other to emerge. Were we going to head into the soft landing in the US, which would have meant that we could shake off the early 2020s without absorbing an enormous amount of damage. Whereas the other side of that US recession, as I keep saying, it's not just about the US, nor just recession, that the downside of the supply shock would continue, that we didn't escape the pandemic era without suffering some longer run damage. That's the risk premium that's in the dollar exchange value over the last couple of years. And if the dollar does manage to break out higher, like in 2022, that would mean the risk premium is rising, therefore more likely the second of those scenarios. To start with, look at the euro. I mean, the euro in Europe is the most obvious weak case. The euro has been, since DXY is largely derived from the euro to begin with, the euro and the DXY trading in that narrow range over the last couple of years. So even though it's more obvious that Europe is in much worse shape than the US, the euro to US dollar exchange value has been largely steady regardless. It isn't interest rate differentials either, as we can see by comparing the US Treasury yields. I'll use the 10-year maturity here, it doesn't really matter. US Treasury yields versus their German counterparts, for example. The differentials really don't explain the behavior in the euro to US dollar exchange value whatsoever. And that's largely because, like I said in the introduction, global bond market is largely globally synchronized. There isn't a whole lot of deviation in those differentials because US Treasuries are doing one thing, more than likely outside of the short run, the ultra short run. German bonds are going to be doing the same thing largely at the same time. So it's not interest rate differentials that really explain the big picture for these currency exchange values, nor is it central bank policies. Even though the ECB is going to be cutting more aggressively, both central banks are cutting, and as we're seeing, it's not interest rate differentials or policy differentials that explain the overall behavior in the exchange value. It's the risk premium. And as Europe goes further and further toward its recession, its renewed recession or accelerating downside in recession, that shows higher degree of risk for more than just Europe. Higher risk premium, US dollar goes up in exchange value. Now, it isn't broken out of its most recent range just yet. It's just getting to the upside. So if the dollar continues to make a more aggressive move to the high side, that's a higher risk premium, and it's not just about Europe, and it's not interest rates, and it certainly isn't central banks. Now, there is one exchange value where we do see a degree of correlation with interest rate differentials, if only because Japanese government bond yields tend to not move nearly as much as, say, the Germans do. I'm talking, of course, about Japan and the yen. And the yen just today is fallen down to around 156 to the dollar, which is its lowest in quite some time, really going back to before the carry trade blow up. And here we see it's not central bank, very clearly not central bank policy differentials, because we have the Bank of Japan that has not only hiked twice this year, the second hike was more aggressive than people are expecting, and the BOJ, now that we're on the other side of the yen carry trade, at least appear to be on the surface, the BOJ is now talking about hiking rates again, if not in December, then at least by January. So the Central Bank of Japan raising rates, hawkishness, whereas the Federal Reserve is finally cutting rates. Not only did they cut by 50 in September, they cut by another 25 just last week, and they're likely to cut again in December. So by the mainstream explanation of central bank policy differentials, the dollar should be going lower with the Federal Reserve's rate cutting, and the yen should be much stronger. Yet instead we see the yen falling. Now, why is the yen falling? Well, part of it is this interest rate differential that we're talking about. Only part of it, though. We're still seeing the yen carry trade being unwound, but we're also seeing the proceeds of that unwinding, selling the riskier assets because the carry traders don't want to be exposed to U.S. recession risk. The proceeds are staying in U.S. dollar denomination, U.S. dollar denominated assets like U.S. treasuries, and the carry traders themselves have said so. So they're keeping the proceeds in US dollar terms, which takes away the repatriation of that reallocation process. And the higher US Treasury yields go because other people are selling them, whereas the carry traders are only too happy to buy them, the less there is of that repatriation, which would be yen positive. So just in the yen carry trade itself, more of the funds that would maybe have been reallocated back to Japan are sticking around in US Treasury assets in US dollars, which at least removes one of the things that would be pushing the yen higher and the dollar lower. But that obviously can't explain the falling yen against the US dollar. Now, there is some portfolio rebalancing. We're out of Japan and into US dollars, but the costs of doing that are rising as well. Instead, we look at other things like the trade deficit, because Japan is running a substantial trade deficit, and that simply means when you're running a trade deficit, you need more dollars in order to buy goods and services. So there is a very good, and I mean very good, long-term correlation between JPY and Japan's trade deficit for those reasons. It's far better than I showed before in a video a couple months ago. It's not, interest rate differentials don't correlate really much at all with the Japanese exchange rate outside of the last couple years. But the long-term relationship between the trade deficit and the yen's exchange value, that's a good one up until the last couple years. It's far better than the current account in Japan because the current account includes overseas financial income that ends up staying overseas, as we just talked about with the carry trade. So it's really about the trade deficit, which includes goods and services. And again, the more dollars Japan needs to buy those, the more there is a demand for US dollars from Japan, which is negative Japanese yen, positive US dollar. But we see is that the trade deficit improved in 2023 as Japan fell into recession and there was lower prices across the board on certainly the items, the basic items like food and fuel that Japan imports. But here in 2024, we see that the Japanese trade deficit is worsening again, not a whole lot, but enough to add some degree of negative pressure on the yen, positive for the exchange rate there in US dollar terms, but it's not enough to explain the entirety of the weaker yen. So when we look at interest rate differentials, while there's definitely a correlation there, in 2024, rate differentials are not enough to explain the degree of weakness in the yen, nor is the trade deficit enough to explain the same thing. We're left looking at some other factor for why the yen might be as weak as it is. And the answer we come back to after eliminating those two, after considering them, is the risk premium. So the risk premium in Eurodollar terms, which means Eurodollar providers are becoming increasingly pessimistic about global prospects. They charge a higher premium to enter the Eurodollar world and transact and do regular business. It's a higher cover charge to participate in the Eurodollar party. So we have the US dollar exchange value rising against the yen and against the euro and against a lot of other currencies, China yuan and everything else. Part of that is indeed differentials, especially where it comes to the Japanese yen, but that doesn't explain what's happening in the dollar. Bigger picture terms, risk premium. We had a huge increase in the risk premium in 2022 as the world came to grips with the fact that the recovery wasn't going the way that it was supposed to, and instead was confronting a whole bunch of negatives in 2020, real negatives in 2022, but they didn't disappear in 2023 and moving forward. Instead, there was a small backing off of the risk premium as everyone around the world waited to see what would happen. China was reopening, Europe may be recovering, the US seemed to be hanging in there despite the banking crisis. So essentially, the dollar system has been charging an elevated risk premium, but still hopeful that maybe everything goes right and we can exit the pandemic era having suffered very little as far as long-run potential damage. Instead, though, we keep going back and forth, and if the dollar does begin to break out of that range, that would be recognition that Eurodollar providers are charging an even higher risk premium heading in the same direction as 2022, realizing that instead the US economy is at risk, the European economy is at risk, Japan's at risk, because the downside of the supply shock still has more to go. So if the dollar does break out of its range here, it goes higher, that's what the interpretation is. It's not about the Fed, it's not about inflation, it's not about Trump. It's about the downside of the supply shock still having more yet to do. And that would mean not just US recession risk, but what US recession risk means in the long run. That we didn't escape the 2020 pandemic and the lockdowns and everything that came with it. We still have yet to pay for it. And in terms of the dollar exchange value, that means a literal charge as far as a risk premium. Like I said, a big part of this is growing fears that China and its stimulus plans aren't going to be enough to overcome all of the negatives there. Went over the China stimulus and update in the video below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.